here and I'm watching the price developing away along in the background like this, and I say, yeah, I'm going to take a pop at some selling in here. I put a sell order in and I put my stops just here. I'm taking a 5-tick stop. Well, in a data release like the non-farm payrolls, Federal Reserve, something like that, some of these data releases, if I do the same trade and I say, right, I'm going to take my sell here and I put my stop here, I'm not going to get filled till here, guys. I'm not going to get filled till there. So my $50 stop here is maybe fair enough. I might be happy and delighted to take that $50 risk. That $50 stop becomes maybe $1,000 here. Don't fall into this trap that thinking that in a big data release that your stop is going to save you. Your stop is going to be destroyed by the liquidity squeeze. Stops will save you in an inverted commas normal market. They will not save you in a data release. They won't save you in a data release. I'll make that and emphasize it and say it another 1,000 times. You will not be safe by putting a hard stop in place above or below a market when a big data release comes out, because it's a market order, remember. It's not a price that you get, it's a price that triggers a trade. And if there's no liquidity for $1,000, you're going to get that $1,000 stop out. So don't fall into that trap of thinking, oh, I've got a hard stop, don't worry about it, I've got a hard stop in place. It's all good. It's not all good. Make sure you know that. Make sure you understand that, guys. It's very, very important when it comes to things like the Fed. And the traders at the desks know that, and that's why they run stops prior to the data, because they want you off and they want you left with that dilemma right at the very end. Because if you've sold here and you've managed to make, say, $400, you've made $400, you might be saying to yourself, well, worst case scenario, surely I've got a $500 stop. Surely it's a worst case scenario, a $500 stop. So really I'm only taking, because I'm up 400, when the data comes out, I might lose $100. I'm willing to take that chance. And you hold on to that trade for 6,000, right? So they don't do that for you. They don't allow you to make that easy decision. You're risking $100 for what you think is maybe $1,000, $2,000. That's an easy money decision. So they don't allow you that decision. They say to you, you want to risk $1,000 for $1,000 profit, 50-50, what do you think? You're looking at it saying $1,000, shit, I've only got a $5,000 account. If I get this one decision wrong, I'm down 20% of my account. I can't take that chance. I can't take that chance. And you stand aside when you get stopped out in the last trade. You stand aside and you let everybody else, the accounts with the big money in it, make the money. And that's why the rich get richer and the poor get poorer. Because the sellers know what's going on. The sellers of gold, the sellers of the pound, because they ran the stops hard against the pound as well. The sellers on the pound, the sellers on gold, the sellers on bonds knew what was happening. And they purposely forced you to make a very, very, very difficult decision, to the point where the 99.999% of traders simply said, no thanks, I'm not going to take the chance. And as I said, I'm not for 1 second suggesting that you should take the chance. What I'm saying is recognize what the risks are and recognize the patterns and the ways that they make you decide to come out of deals. Should be pretty obvious. Hopefully it is pretty obvious. We did a classroom this morning on bull and bear flatteners and steepeners. We may well have a chance to go back over that, but it was really in response to Tim's question from yesterday, and I knew Tim was in this morning, so we did that class this morning. So if we get a chance, we'll maybe go back over it quickly to talk about it. We also talked about the Fed, obviously the signals that we had pre-Fed. We talked about the very, very obvious program trades that were kicking off prior to a data release. We talked about the carry. We talked about inflation, break-evens. We don't change lines, by the way. The lines you'll see today will be lines that you saw tomorrow. And the lines you see tomorrow will be the same as the lines you saw last week. And the lines you saw last week will be the same as the lines you saw 2 weeks ago. They're always the same lines. They don't change. When we talk about inflationary break-evens, we're nearly always talking about one of two things, ZB tips or oil. If we're talking about the real yields, we're talking about tens in oil. If we're talking about these things, they're always the same. They don't change. It's not a series of new things, a series of new pieces. And the key to that is that you understand what each of them are as you go through the learning courses, as you go through the education. You'll learn what the inflation break-evens and when you should use it. You'll learn how to use it. You'll learn when to apply it properly. Because obviously it's an incredibly important piece of information when we come into things like the Fed. Because the only people that trade the tips markets, guys, are really the direct dealers. The inflation desks across all the banks. Nobody in the retail space trades these things. So we understand that the inflation break-evens is a very substantial institutional trade with institutional money. And if you saw inflation break-evens last night, guys, you wouldn't have had any question about what to do in bonds. Inflation break-evens were rocking to the upside. It means that obviously inflation is expected to rock to the upside. Well, obviously ahead of a Fed announcement, it wasn't just one or two ticks, by the way. This was significant. Ahead of a Fed announcement, what does that mean? Ahead of a Fed announcement, that means that the direct dealers on all the major bank desks are buying inflation products. They're buying inflation hedges. Why would they buy inflation hedges ahead of a Fed announcement unless they felt that the Fed was going to come out with some sort of hawkish statement? Doesn't make any sense otherwise. So all the direct dealers in the world were buying these massive inflation hedges before the Fed, and then the Fed comes out with this hawkish statement, and they make a fortune. And if you understand that and you're a bond trader, you make a fortune. And if you understand that and you're an equity trader, you make a fortune because you would be selling equities in a hawkish Fed, wouldn't you? If you understand that and you're a gold trader, you know that's going to pop real yields. You're going to be selling loads of gold. You're going to make a fortune on gold. If you understand that and you're a forex trader, you're going to be buying dollars wherever you can get them because a hawkish statement's going to lift the dollar massively. You're going to make a lot of money. Well, Paul says they're smart guys. Well, they are smart guys for being in the right place, but they're not smart. And as much as, guess what happened, Paul? They probably spoke to somebody on the Fed New York desk a few days ago, and they got a read on it. Don't think it doesn't happen. Don't for 1 second think that that phone call didn't happen to the direct dealers. Because they're direct dealers. That's why they're direct dealers, because they've got a hotline to the Fed. The Fed does not ever move without consultation with Goldman Sachs. The Fed never moves without consultation with Bank of America, UBS, Barclays, Nomura. Fed never moves without speaking to the major banks. So not for 1 second do you think that's by chance. Not for 1 second do you think it was some sort of advanced algorithm. It was just a backdoor deal. It was just a phone call. What are you guys doing tomorrow? Oh, well, I'll tell you what. Off the record, of course. We're going to be a bit hawkish. We're going to be a bit hawkish here tomorrow. So what I think you guys should be doing is this. And then that's what they did last night. They did it before the release. And then that feeds into the program trading sellers that come in that we showed you earlier this morning when the program sellers were smacking equities off the highs every time, left, right, and center. Fortunes made for people that actually understood and appreciated this, guys. And yet they tried to shake you off the trade. They tried to shake you off the trade 1,000 times. Get off, get off. You're on the wrong trade. What the hell are you selling bonds for? Look, it's going higher, guys. If you don't realize that that's what happens and why it happens, you haven't really started in this class yet, have you? You've not really grasped the process that we adopt to get rid of you guys as much as possible so that you guys can appreciate when it becomes the obvious. So welcome in, guys. You might recognize a very interesting oil trade. $72.25. We did a class just a short while ago about the 25-cent level. And you can see that we got that top edge, 72.25. We got a brilliant little sell down to 70s. 55 ticks of beautiful sell side profits, guys. Unbelievable. Not really. It's what we did a classroom on just a few days ago. Had you cared to remember about it? Pretty good, I would say so. Anyway, welcome in, guys. In other news, obviously we had the SNB coming out, leaving interest rates on hold as expected. This afternoon, we've got a couple of things. Where are we time-wise? 3 o'clock, conference board's leading index. That's still to come out. Obviously, most people are still looking at the previous day's data and adjusting according to that data. But what we have seen from the US has been so far slightly mixed. The unemployment claims have increased to 412,000. The Philly Fed manufacturing was actually slightly higher at 30.7 against a prior of 30.3. However, the prior was 31.5, so it is slightly lower. So two pretty poor numbers from the US. You can see that the response to that has been a slight uptick in the market against the dollar, but very minimal, simply because everybody's still looking through and talking about the ramifications of the Fed from yesterday and seeing where, if anything, they can position some big trades. And that's what we're looking at, guys. Earlier on in the overnight session, we had the Australian employment change showing a very, very substantial gain of 115,000, while Australia's been in a little bit of a better, more advanced position than some, and the unemployment rate dropping from 5.5% to a more manageable 5.1%. Of course, still a very, very high print in relation to historical averages. You can see that from the Forex Factory print. You'll see that this is still a high print here, but it's obviously starting to come back down to the pre-pandemic percentage numbers. And obviously this is the pandemic pop that we've got on Australian unemployment. So you can see those numbers, and obviously, as I said, this afternoon, not a lot. 3 o'clock, we've got this conference board's leading index. Again, forecast to be a little bit softer. And we've also got the natural gas storage numbers coming out this afternoon at 3:30. And that takes us through to a very quiet Friday. There is nothing in America on Friday at all in terms of data. So a very, very quiet Friday for a change, guys, and people just doing a bit of position adjusting on Friday itself. So welcome in. I hope you're all good this morning. As I said, just a bit of nonsense yesterday. A lot of stuff kicking off, a lot of business doing bits and pieces. And difficult to get a read on the balance, but in general, if you were to trade the 8:30, which we've told you before, the first trade was bearish. If the first trade's bearish, what does that tell you? That the market maker is in? They're in a bullish position. Why are they in a bullish position? Because they've obviously ended up taking the other side of a commercial seller. So you're already thinking about selling last night at 8:30, aren't you? So if you're looking at selling at 8:30 this afternoon, the sell-off of equities at 8:30 was at 42.26, 42.25, 42.24s. This morning it traded down as low as 41.83s. A monstrous $2,000 sell-off based simply around the 8:30 trigger that I've given you before, that most of you have probably all forgotten about already, but it was still worthwhile mentioning that was another signal that you could have used to make yourself another fortune again last night. But it's not my problem if you can't remember how to use these things. It's not my problem if you have a brain like a sieve or a brain and a memory like a goldfish. That's entirely up to you to fix, and that's up to you to make sure you get the trades on. So we're coming, guys, on that cheery note. I hope you're all good, ready to get started. I'm going to grab a bit of lunch, and then we'll get fired off. I haven't